Welcome back everyone. James the finance guy going to talk about what is investing part 2. The financial advisor. This aspect over here is what we're going to cover today. Otherwise known as a broker, a financial planner, investment manager, a portfolio manager, finance guy. What is this person? This person is somebody who is a professional who you would like to take care of something that you would not like to do yourself. So in effect, it's the same thing as letting your doctor take care of your health issues, letting your lawyer take care of your legal issues, an accountant, your accounting issues. A financial planner is going to take care of the planning of your finances for you. But James, why do I need a financial advisor? Surely I'm smart enough to be able to do all these kinds of things myself. I've got Google, all that kind of thing. So why can I not just cancel out that whole aspect there and just jump straight into doing these technical, really complicated things myself? Well, you can. You can definitely do it yourself. Would you like to also fix your broken leg? Would you also like to submit your tax returns each and every year? Would you also like to represent yourself in a court case? Well, some people actually do want to do all those things themselves, and for them, they don't need a financial advisor. But I'll give you some empirical evidence as to why it is a good idea to use a financial advisor. So Vanguard did a study in the US on clients, investors who had an advisor and their performance versus clients who did not have an advisor and their performance. And basically, it boils down to a couple of aspects that the advisor, at the end of the day, regardless of what they charge for the advice, will always give you better results long term. Number one, it is an independent third person who is going to do the best thing for you and is unemotional about the consequences of what those decisions are. So it being your own money that you're investing, you tend to be a little bit more skittish about losses, a little bit too greedy about gains. An advisor will look at your goals and say, these are the decisions we're going to make to achieve your goals objectively. All right. So what is that? Emotions. Keeps your emotions in check. Next, behavior. Okay, so basically when you are an investor, you want to make sure that if you have a debit order going, that every single month you're contributing towards your investment, getting to your goal. If you have a retirement annuity, that you contribute into your RA to get your tax deductions every single year. And that is all behavior. It's habit forming. Your advisor will guide you along those steps. They'll remind you. They'll get you to do the things you need to do, what you know you should be doing in order to achieve your goals. Then we have asset allocation. All right. Asset allocation is the distribution between the different types of investable assets that you can invest in order to achieve your goals. So the right amount of equity, bonds, cash and property exposure, commodities, ETFs, whatever, currency. So the financial advisor will be well versed in the correct asset allocation for you, so that, for example, if you're trying to save for your retirement, you don't just stick all the money in the bank, which is the worst possible thing you could probably do. Correct asset allocation. Then cost effectiveness. So cost effectiveness, it basically means that whatever you're going to invest in is going to be at the right cost and in the right fees and charges for you. And the advisor will know what are the right costs, what you should be paying for certain products. Otherwise, you might get taken advantage of. You could walk into a bank and they offer you the first product off the counter, which might cost too much. Maybe there's some hidden commissions, there's some fees that you're not aware of. The other thing is, a lot of the time they'll have scale on their side. So because they've got a lot of investors' money that they pull together, they can actually negotiate much cheaper fees at platforms and investment houses, etc. And lower costs means better growth at the end of the day. So that's very important. Then we have tax is a critically important part, because you could invest in something which has fantastic growth, it's shooting the lights out, you cash it in, all of a sudden you realize, oh no, the revenue service has said that 40% of that is theirs. No good. That's it. So all of these, they've got certain amounts of percentages that is the effect, and what they've figured out was that on average, having an advisor gives you 3% better growth every single year on average over the long term. These are the client's performance or outperformance with advisors, and those clients without advisors missed out on that. So that's the reason, even though you could do investing planning yourself, get a professional to do it for you. Broadly speaking, there is only two types of financial advisors. There is an independent financial advisor, IFA, and a tied agent. So difference is independent, like the name suggests, they are completely independent of any particular product offering, any particular investment house or company. They offer you the broad spectrum of what's available in the market, and the idea is that they can offer you anything available, and with a wider selection they could probably find the things that are best suited for you. A tied agent is someone that works for one particular company, and they can only offer you products that that company offers. So in a way, it looks something like this. The independent financial advisor can offer you, maybe there's 5 companies that have the product you need, and each of those companies has a different selection of possible options there, and the independent financial advisor can get any one of those products. The tied agent, however, only works for one company. However, they might know a lot more about that one particular product offering compared to an independent advisor that knows a little bit of everything. So it's kind of like jack of all trades, master of none. But at the same time, how do you know for sure that only this one particular company is the best and maybe not some other companies or a combination of other companies the best for you? So those are kind of pros and cons, IFA versus tied agent. The next important thing to understand is the FSB number, all right? This is the Financial Services Board. It's the regulatory authority. It is the governing kind of institution that makes sure that if you are a practicing financial advisor, you have to be fully accredited, you have to have the right education, you have to have a certain amount of experience in the industry, all that kind of thing. If you're also registered, you'll have an FSB number, and that is something you must always find out. If somebody comes up to you trying to offer you financial advice, telling you to invest in this and that and whatever, first things first, what is your FSB number? If they don't have an FSB number, walk away. Okay, sounds quite good. I definitely want to use a financial advisor now. But how do I find one? And how do I know which one is good and all that kind of thing? So, very good question. It's the same thing like, how do I know which doctor to use? How do I know which lawyer is going to be best for me? Pretty much the same thing. You basically have to go out there, do your homework, do a bit of research, find out which is your local financial advisor around the corner. So potentially, let's call it, you get the local broker. Potentially you want to maybe go for a large advisor firm, so a big company with lots of advisors out there. You can even go to your local bank. They probably can put you in touch with an advisor that works for the bank. You can go online. There's different avenues. Ask your friends, ask your family, who do they use? And don't be afraid to chat to the person first see if you're comfortable with them, get a couple of opinions, at least 2 or 3. Spread your bets and have a look at your options and go with the person that seems like they know what they're talking about, that they have a bit of experience behind their name, that they're with a reputable firm. And ask your friends and family, look at the media, look at the news, see if that firm is either well known or has got awards, has won competitions for giving good advice, or that kind of thing. Find an advisor, very important. If you do not get good advice, or there has been advice that has caused you to actually suffer financial loss, you do have recourse. That's why the FSB number is important, because with this FSB number, you can approach somebody called the FAIS Ombud, all right? FAIS, which stands for the Financial Advice and Intermediary Services Act, Ombud. An ombud is an ombudsman. They basically make sure that the laws that govern a registered FSB is adhered to, and they can actually represent you legally up to certain values, and they can make sure that that advisor pays you back for any bad advice that they've given you. So just remember that an advisor that gives you advice is liable for the advice they give you. So it's absolutely to their advantage to give you the right advice. So that's a very important reason why you want to use a professional, not just listen to the hearsay and go by the rumor mill at the braai. What does a financial advisor actually discuss with you? What does that first meeting actually entail? Important aspects to cover with the advisor. They are going to establish your goals. Typical goals could be a bond on a house. Maybe you want to save for vacation every year, vacation fund. Maybe you would like to retire, so retirement. Okay. Maybe you have a kid that needs to be educated at some point in the future, so education fund. Typical kind of investment goals that you might have. Next aspect, the advisor will establish the timeline that you'd like to achieve these goals. So a bond on a house might be, let's say, within 3 to 4 years. A vacation fund is probably an annual thing, so every year you want to build up a little bit of capital to go on a holiday. Retirement would probably be the longest timeline that you can invest for. And an education fund, depending on the age of your children, the timeline will determine what kind of investments are most adequate for the goals. Then the last aspect over here is your risk profile. Risk profile basically means how emotional do you get about the volatility of your investment. Volatility means it going up, down, left, right, all around. You get scared, pull all your money out, bad mistake. So if you're that kind of skittish type investor, it's good for the advisor to know that, so that they can invest accordingly to make you not be put in a position where you feel uncomfortable. So let's say you have a skittish temperament, you would probably like an investment profile or a return profile that looks like this. So you start off with $100, and over time it grows nice and steadily, and maybe after a couple of years it's at 120, and at no point did you lose any substantial amount of money during that period. So when you check the balance, it goes up nice and predictably. The other type of investment you could do is something that is very volatile. So here maybe you start with $100 and it looks like this. Goes up, down, and all over the place. Now, if you are skittish and you're in this first camp over here, and maybe a year after you invested, you have a look at the balance, boom, you've only got 80 Rand, but you invested 100. Scary, you know? Can you handle it? Maybe not, and you cash out then. bad mistake, because in this specific example, this fund actually, even though it was volatile and went through periods of up and down, did a lot better than the conservative fund, and you actually made a lot of money if you just stuck the course. So this is the end result if you average it out. But these periods of volatility might not be for you. So you need to determine whether you are a conservative investor who would just like a predictable return profile, or an aggressive investor, assertive type investor who's able to take the knocks but knows that long term you're going to get a better result. If we go back here to what is investing, this is what we covered today. The financial advisor, who he is, what he does, why it's important, the things that they have to determine, and with all of that information, he is then going to be able to go into the next step, which we'll cover next week. This week's video, a lot longer than the first video I did on this series, and that's because we cover in a lot more detail. So hope you enjoyed it, hope you learned something. Please subscribe, please hit the like button, and if you have any questions, feel free to ask. You can direct message me if that's possible on YouTube, I'm not sure. Otherwise, leave a comment and I will get back to you. James, the finance guy, signing out.